In part 2 of this video, we'll look a little closer at the actual market for debt. That is, we'll talk about the different forms that debt can take with respect to time and with respect to the type of issuer that can issue the debt. So the bond market is essentially an over-the-counter market, right? It really doesn't trade like stocks trade. They say here that it's a little bit more stable than the stock market, and I believe that's probably true because essentially it's more certain than the stock market. And there is some growth in this bond market. So companies do tend to be borrowing a little bit more over time. Now that growth may also be indicative of governments that are also borrowing. So there's a not really sure of how that essentially breaks down, right? So we want to talk about the segments here. So there is something referred to obviously as treasury debt, treasury bonds. We talked about the difference in definition between notes and bonds, right? A note is going to have issued maturities from 2 to 10 years. Treasury bonds is anything over that 10-year period. Interest is paid semi-annually, and interest is exempt from state and local taxes. So you get a break from state and local taxes if you invest in treasury bonds. Treasury debt is all non-callable debt. The government is not allowed to call their issues. And certainly from time to time, the government has to issue more debt. So it is a regularly scheduled kind of a system where the auction takes place and this debt is issued to the public. There is a segment of treasury debt, though, that's very special, kind of an area that are referred to as inflation-protected securities. Essentially what this does is that the coupon is attached to principal, and principal is attached to inflation. So as inflation changes, the principal changes. And when the principal is changing, that has an impact on the coupon because the coupon is a percentage of par. And again, these are typically, 5, 10, 30 years. Interest is semi-annual. And since they are inflation protected, they essentially eliminate an entire category of risk, which is this purchasing power risk. So if you look at two government bonds, two 30-year government bonds side by side, one is a TIP and one is a regular government bond, the TIP has less risk. Since it has less risk, it will also have a lower rate of return because naturally, as we've been talking, lower risk things should have lower returns. Attached to the federal government, although not necessarily part of the federal government, it are things referred to as agency debt, right? These are issued by certain agencies that are allowed to provide debt and create debt. Most of these you're probably familiar with. We have bank loans, right, that are federal loan banks, these are all mortgage loans. The SBA can now create debt and issue debt. And the Fannie Mae is a government agency that has what's referred to as mortgage-backed securities. We'll talk about them here in a second. But this debt is a high-quality debt, right? There's almost no risk of default. However, they are not part of the government. They cannot create taxes, so they cannot cover any challenges that they have with making payments. So typically they'll be a little bit higher yields than treasuries, but not by much, because by definition, I guess, the United States government would never let one of their agencies default on their debt. Municipal bonds. again, a form of government debt, but this is not federal government, this is state and local governments. So they're going to, this is for things like school districts, water and sewer districts, etc. This is how state and local governments run their business. So general obligation bonds are backed by the full faith and credit of the taxing power of the issuer. So think about the ability for the state governments or local governments to change taxes. It's not great. And frequently it has to go through a vote of the public. So sometimes these general obligation bonds will not be renewed because the voting public feels the money's being wasted or whatever. But general obligation bonds are just backed by the ability to tax the issuer, taxing power of the issuer. Revenue bonds come from projects. They're like an income bond, like a toll road. Now, the challenge that we have is that there's this risk factor, right? What is the chance that the entity will not be able to raise taxes or have enough taxes to cover the payment? Some of these municipal bonds will have a guarantee. Essentially, they buy a form of insurance, which improves the quality of the bond. If they improve the quality, then they'll have a higher rating, which means they'll have improved liquidity. Higher ratings means they'll also have lower returns since they'll be lower risk. Now, one of the tax advantages to a municipal bond is that it is exempt for federal taxes, of course, but also municipal bonds are exempt from state and local bonds if you live in the state where the bond was issued. So if you live in Kentucky and you buy a Kentucky state municipal bond, then you will not pay federal taxes, and you will also not pay state and local taxes on the interest from that debt. So there's obviously a benefit. So in order to make comparisons, we need to convert our government debt to what we would refer to as a taxable equivalent yield. So essentially what we want to do is we want to take the yield of the bond and we want to convert that to what it would be if that bond was actually a taxable debt. So our formula, you take the yield on the municipal bond and you divide that by 1 minus the federal tax rate plus the state tax rate times 1 minus the federal rate. So let's just look at an example of this. There's two bonds. We have a corporate bond that has an 8% yield. A state bond has a 5% yield. And you're in a 25% tax bracket, and your state has a 3% state tax. What is the equivalent tax yield? So plugging into our formula here, we find that the taxable equivalent yield is 6.87%. So the question you have, if we assume that these are the same risk level, if these things are identical in risk, which would you rather have? Would you rather have 8% or would you rather have 6.87%? So what this tells us is that the 8% bond after taxes will yield more than what this state bond will provide after taxes. So the way the table sort of works, if you look, these going across, these are all different municipal bond yields, right? Tax-free yields. Going down, we're looking at different tax brackets. And as you can see, it doesn't really matter what yield you look at. As you get to higher and higher tax brackets, the yield becomes higher and higher, which means the municipal bond becomes more and more attractive as tax rates go up. So this question of whether you should buy a municipal bond is really dependent on your tax rate, your personal tax rate, as much as it is the quality of the debt itself, because the impact will ultimately be how much you take home, not how much you make. Obviously, corporate bonds, there are a great variety of corporate bonds available. They typically break them down into some categories, right? Industrials, public utilities, transportation, financial services. All of these segments have different characteristics, different average yield, etc. Um, Again, the reason people really like debt, or the people why they want debt, is that it has steady, predictable income. And as long as the entity, I've said this several times, as long as the entity doesn't go bankrupt, you will be assured of getting your cash flow. And in the end, that's what people want. Again, a couple of specialty issues to talk about. Zero coupon bonds. They don't pay any interest. So they sell at a discount. Sometimes it's referred to as a deep discount from their par values. Now what happens is, since they don't pay interest and they sell at such a low discount, over time, as we talked about earlier, the price has to move towards $1,000. So again, if you think of nothing in the world happens other than time, every year there will be some capital gains that are realized, right? Paper capital gains that are realized, and of course they're not taxed until you sell. Because of this issue, the government also taxes these zero coupon bonds differently than any other investment. So you will pay taxes as you go, even though there's no actual interest received. So there's lots of price volatility here. Some of these are issued as zero coupon bonds. And on the government side, sometimes they have what are referred to as Treasury Strips. This is actually created from Securities. It could be created by a broker. So a broker buys a United States government bond that pays interest, and then they sell that in two pieces called Treasury Strips. Another specialty issue is something referred to as a mortgage-backed security. This is a security that is backed by a specific kind of asset, a residential mortgage. So the monthly payments that the homeowner pays, right? Part of that is principal and part of that is interest. So a person who buys a mortgage-backed security is also going to get a monthly payment. And again, part of that is the earnings, the interest earnings, and part of that is the return of principal. So this is also what's referred to frequently as a self-liquidating investment, because every month part of the payment goes to pay off principal and part of it goes to pay interest. So there are only a few agencies that can issue mortgage-backed securities. The Freddie Mac, the Federal Home Loan Mortgage Company, and the Federal National Loan Home Mortgage. These are all, Ginnie Mae, sorry. These are all organizations that can issue debt that are backed by these mortgages of residential homes. A collateralized mortgage obligation is a mortgage-backed pool of investments. And essentially what happens is they divide this debt into what they refer to as tranches. And depending on what kind of a tranche you want, what kind of an investment you want, you can purchase a short, intermediate, or long-term investment. Now the challenge with these is that these bonds are very risky. They have a prepayment or a call risk, but also each level of risk has its own level of prepayment risk. So this is one of the types of debt that got the mortgage market into so much trouble recently, is that when you take mortgages and you separate them into parts, sometimes you're taking apart an entity, a security, and you're putting parts of it in three different places. And once you've created this a gravy, if you will, of mortgages and spread them out, once you've created the gravy, you can't take it apart. So they are a little bit on the risky side. Asset-backed securities are very similar to the mortgage-backed securities, except these have different types of debt, right? So auto loans, credit cards, some equity lines of credit, right? These are basically business kinds of loans that are pooled together and then sold out to the public. Again, interest and principal payments are paid monthly. Typically, they have high credit quality, right? These are typically issued more by corporations than they are government agencies, but they serve the same purpose. That is to provide these investments, if you will, that are backed by certain types of loans. The last type of specialty issue really isn't a specialty issue. It's just a category of debt, right? Junk bonds are sometimes referred to as high yield debt securities, right? High yield means high risk. So junk bonds typically are higher default risk. They have higher yields, of course, because of this risk. And if you look at the prices of these things, they tend to move much like stocks do. So they work a little bit, they act a little bit more like stocks than bonds with their volatility. But the important part here is that they are higher risk things. So if you're an investor and you're very aggressive and you can find companies that you feel may improve their financial situation, maybe their debt that's classified as a junk bond is the debt that you might want to invest in. So that's the end of this video on valuing or looking at fixed income securities.